It's back to those all-time highs again. Post October 19th, 2021, we're back to 18,604.45. For the longest for the longest time this afternoon, we were zero point 0.1 10 basis points away from there, and we were hoping that it happens soon because it's good to get some levels out of the way, and that's happened. Now the question is where to from here, and is this really that great piece of news? Because I hear so many complaints about how individual portfolios are not performing. Come on, guys, we're at all-time highs. We should celebrate this. In order to do that, two very smart voices to talk about what next. Mrinal Singh, Ajay Srivastava, gentlemen, both of you, thank you so much for taking the time out and being with us. I'll start off alphabetically. Ajay, happy, relieved, or are you constructive about more coming up?
No, I think one, it's a great milestone. In the background of the global scenario, I think it's a bigger milestone. Let's be honest about it. It's a no fact. Number two is this milestone is not about important for secondary market. I think the biggest thing it has done is given the impetus to the primary market. India is the only country at this point of time which is having IPOs. Now that wouldn't have been possible if the buoyancy in secondary market was not there, even though we were lower than the 52-week highs, but still it sailed through. So I think, in terms of pure optics, that yes, we have scaled a high, it's a great thing, but it comes with a lesson. And I think the lesson is that equity investors are not making enough money to justify the risk premium of equity market. If on a year-to-year basis, you just made zero return on an equity portfolio, then you, for the next 2 years, you really got to produce super normal return for yourself and your portfolio. And more important, 26 or 30 of the Nifty 50 at the end of the day are significantly below last year's number. So, so two things. One, good, important milestone. Second, look back and look at your portfolio and see what you need to churn. Because if you're not booking profits, if you're not taking out laggards, index and market is not going to help you. It's not been a friend for the investor. You've actually lost money compared to being just like the PF, for instance. So I think landmark celebration, but also a little bit of go back introspection to say, how do you need to do better in equity markets? Because no returns over a year is not a great celebration for the investor, right?
Yeah, I was constructing this whole argument about how people should not be unhappy about it. I was trying to make a balloon, and Ajay just punctured that completely. Ajay, thanks for that. But Mrinal, coming on this, I mean, you can look at it two ways: glass half full or glass half empty. Glass half full is that with the and as Ajay said, that with the global markets having done what they are, save for IDX and maybe a couple of others, most markets are down in the dumps, and we are what 5% plus YTD. But the broader end of the spectrum is still some 100 points away, a few 100 points away from those all-time highs. So how do you look at it?
So it's a great psychological barrier. I mean, no doubt about it. And most people are kind of wondering that why are my portfolios not resonating that euphoria and feeling. But the reality is we are very likely in an investing time zone where the returns are going to be very divergent. I think the beta support that market has given for last 3, 4, 5 years, I think is kind of gone away, and we are in an alpha market. By that I mean that individual business or sectors can have very, very divergent return profiles going ahead compared to the broader indices. We might also have a situation where, let's say, a mid cap index might do X, the small cap index might do 3X, or large cap index might do 0.5X. All those kind of things are going to happen. So it is an arena, in my view, for more experienced, more data oriented, more long term oriented, and more valuation conscious investor. Traders will also find good space, and obviously the swing in the market will persist. The global landscape on capital is shifting. We are kind of seeing that the capital, there is cost being associated with the capital, and risk capital is shrinking. We see in and out of flows from the foreign investors, but the domestic flow towards financialization and equity has attracted a large portion of it, will continue for some more time and maybe longer. So these are landscape we need to be cognizant of. Our markets have become really relevant in providing or allocating capital to enterprises. A lot has changed when I look back 20 years ago, what kind of businesses we had and as an option to invest into, and what choices we have. I think we should really celebrate that. we've come a long way in terms of what choices we have, what kind of transparency, and all kudos to the combination of regulator, investors, industry participants, institutional investors, the government, and everything. I think it is worthwhile that we have created a legitimate platform for investors to invest and do good to themselves and the society. I mean, it is worth being happy about.
Yeah, I mean, to an extent, I was thinking that some of the SIP investors, I was saying this in my trade setup as well. Some of the SIP investors would have been a happy lot for sure. Now, Mrinal, just quick follow up there. Broader of the spectrum hasn't quite performed. Do you think it's their turn now? Because when I look at some of the most experienced chartists, everybody's talking about how the Nifty itself is slated to inch up higher over the course of the next few months. Do you think broader markets will outperform or underperform?
So the question is a tricky one. Why? Because the broader market will never outperform or underperform itself, because that's the broader market. But will we see some sectors doing extremely well to the broader market? My answer is yes. I mean, no doubt about it. We are already maybe in some distance into that. And I think there are some sectors which might not do that well. But after all, the indices is a weighted average of some stocks. The index itself in the next 2-3 years will see a lot of change. The index in a way is like a rear view mirror. It encompasses businesses which have done well in the past to both the profits, investors, and all kinds of stakeholders. And there is a new set of businesses which are going to do well. Some businesses from the past will continue to be part of it. Some businesses will get surpassed. Some businesses will lag behind. That's the nature of the beast. That's the evolution that we will see. And we will see it in a more prominent way compared to what we've seen in the last 4-5 years, is how I
most certainly. Just some signs of that are evident, right? I mean, you don't expect PSU banks to be rank outperformers 2 months on a trot. And here we have them sitting on top of the pile. And despite everybody's disbelief, continue to do well. So here's the question, and there's a wry smile on your face. I'd love to know why, but here's my question, right, Ajay? What do if we go with the presumption that broader markets are going to do well, is it the laggards which play a catch up? And for fundamental reasons, I'm not saying just from a catch up perspective. Will the laggards play a bit of a catch up because the cycle may turn, etc., may happen? Or do you think the growth stocks will, or even growth may come back? For example, because growth has underperformed value for the better part of 2022.
So two things will happen. Volume growth will get very well rewarded by the market. That's definitely going to happen. So markets at all point in time, irrespective of the time zone, love growth. So genuine profit and volume growth, the markets will reward you. I mean, whichever business. There will be catch up that will happen on the, I would say when the pendulum swings way too much on the lower side and the outer side, so that catch up will happen. So, but what is important to know is that growth will be difficult. So it will become a narrow market and it will be very heavily rewarded. See, because the global economies are kind of getting into slow down, to say the least. So the push of demand and being able to grow consistently will be a difficult task, but it will definitely get rewarded as and when it happens. And they will, along with that, there will be swings that we'll see from the catch up or those kind of things or value that will happen. That would be a large part, yes, and growth will be very handsomely rewarded.
Got it. Ajay, same question to you, Ajay Srivastava. What's your thought there?
See, I think we are in a growth starved market. Whoever is buying for PE expansion, by and large. I have not understood debate on value, growth, etc., because I look at a company as a company. I don't look at a company as a value company or a growth company. I think bottom line is still where it is, that underinvested segments of market to perform well in short duration. You mentioned PSU, it will perform well because it had very absolutely underinvested segment of the market. No mutual fund was there, no PE was there, nobody was there in that market. And the liquidity, thanks to the last infusion, the liquidity is down to 10-20%, except State Bank of India and most banks in the market. So I think you will have those pockets coming in. But the key is not about just the pockets. The key is not about value growth. Key is, do you book your profits and get out? Because I think Mrinal made a very good point. And I think the point was, you will not find many companies in the index 3 years from now, which also tells you, you'll not find many companies giving you returns for now. So therefore, for an equity investor, the challenge is today that if he has to make an alpha on a 10% debt return or 12% debt return, what kind of return is it expecting and where will it find that kind of return? And that's a difficult answer to give. Therefore, today, fixed income in the last 2 years has given better returns to investors. I think in next 2 years, it will still give better return than equity market because, for every smart buy that you make and you announce in the cocktail party, there will be one dud which you want to hide under the table. You don't want to look at the share price. I don't know if you noticed it. You don't want to look at some share price of some of the shares. You just ignore it. Say, I don't want to recognize the reality. Okay. So I think for every smart move you'll make, you'll find it done. So I think, in this environment, you need to look at fixed income. You need to look at investment REITs. You need to look at power REITs. You need to balance your portfolio. On a broader sense, you got to be really lucky to do a 17-20% return year on year in this kind of market. Market hasn't done for last 2 years. For you to do it, your choices got to be impeccable on this path. And more than choices, timing of entry and exit. If you're buying at 19,000 index, God can only help you to make a 20% return. That means expecting the index to go to 22,000. Patience, buy right. To me, that's the more important thing. Euphoria is to enjoy. Euphoria is not to put in money.
That's a powerful statement. Ajay, my final question to you and then the final question to Mrinal. So, would you bet a larger proportion of your fresh capital on a dark horse, or would you bet a larger proportion of your capital on a near certain idea, even if with an assumption that the near certain idea will probably not give you as much return as the potential dark horse would, from these levels where we are at currently? Ajay, the question is for you.
I think one needs to bet on dark horses because in this market, sure bets are discovered bets, which is a sell on eventuality. News is get bought into and you'll be saying it. Bank is the same story at the end of the day. Today, some banks, see again, bank is a story where it will be a good investment, but I don't think bank will ever give you the alpha return. Bank, even on this year, at the highest rate in 365 days, has given you a return. Bank index is 15.6% to be precise. But doesn't, and that also quite a bit came in the last 90 days. So I'm just saying that banks can give you the traction. And you saw what happened to HDFC Bank. 5 years, almost zero returns to investment. So banks is good for institutional investors. Is good for you as well. I think it'll do well. But I don't think they will give you an 18% return at the end of the day. So therefore, you need to go find candidates, even in the banking, or you got to find candidates in the dark horses of the world. Restructuring stories, why call it dark horses? To me, India's restructuring stories are the best dark horses. You don't need to go far. PE funds are taking stake in them at the early prices. You need to go. When Adani bought, let's take the example, Ambuja Cement, it was 382. You could have bought the share at 382 along with Mr. Adani at the entry price. Some people bought and the returns came out very good. So, so Advent bought Eureka Forbes. If it bought the day deal was announced, your returns became 40%. So I think you have to follow the lead to say where the big ticket money is going, restructuring stories. Those are the dark horses which are publicly announced. For whatever reason, nobody acknowledges it. So I would say focus your money on them. If an Advent is putting money, if Mr. Adani is putting money, and you can come at the same price or almost the same price, man, you don't need to think twice.
Okay. But viewers, please do think and choose. Ajay Srivastava will see 10 such deals and invest in 2. You shouldn't invest in all the 10. That's the limited point. Mrinal, final question to you really. Where is it that you are betting on now that we are at all-time highs? I mean, is it what themes look the best? And again, the same question to you. Near certainty may be valued to perfection, so to say. Are you betting there or are you betting on some of the contrarian bets?
So, well, certainty is priced in. I mean, we are not naive. The market is a very smart bunch of people. Yeah. If there is something in the public domain, you can assume it is in the price. To make monies from here, you would require to uncover something that is unknown or underappreciated. So you call it dark horse, you call it value, you call it contrarian, but basically the risk reward has to be favorable. You have to go right and the market has to reward. All 3 steps have to happen. Sometimes things happen, markets doesn't reward and all of those things, but that is where money will be made. Your patience will be called for. This is not a market for impatient investors. Biases will work against you. Please hold your biases, control them. Don't fall in love with your stocks. Try buying businesses. Don't try to play the game. And become a long-term investor, become patient, respect the prices. As Ajay is saying, if things have moved up too fast, too soon, don't be wary of booking profits. That's perfectly okay. So the classical things, Neeraj.
Got it. Well, I think the standout for me, as both of experts are saying, that maybe don't look at just the private invested and keep on booking profits. That seems to be the mantra. Ajay, and both of you, really appreciate you coming in on such a short
Thank
notice,
you.
but it's just such an important day. It was great having you. Thanks both.
Thank you very much. Thank you. All the best.
Thanks for tuning in.